Did you know a single computer coding error recently cost investors $217 million?
Or that elite venture capitalist poured billions into a crypto exchange that didn't even have a chief financial officer.
Right. And we have even more startling insights, data, and facts to share, so ensure you stay on till the end to hear them. Welcome to the IMN Podcast.
It's great to be here.
Today we're exploring a really fascinating phenomenon, something called the intelligence paradox. We're looking at how core market intelligence and just fundamentally flawed due diligence cause massive, incredibly costly mistakes for the absolute smartest investors on Earth.
Yeah, we are talking about hedge funds, venture capitalists, private equity, investment banks, pension funds.
The heavy hitters.
Exactly. The foundational belief on Wall Street was always that more data would just, inevitably lead to better intelligence, lower risk.
But the paradox is that as the tools for gathering info have become vastly more advanced,
The capacity to identify systemic risks has actually diminished in some really catastrophic instances.
it's wild to think about. And for you listening, here on the IMN Podcast, we try to make complex subjects easy to understand through these relatively short podcasts, explained in simple language, and also provide insights that are often missed.
Which is so needed right now.
Absolutely. And I should mention right off the bat, this podcast is brought to you by IMN. You should visit the IMN website via the link on the channel profile to understand how it can provide incredibly helpful personalized information about virtually any subject relevant to you as a professional, business leader, or even in your personal life.
Because they actually synthesize the data.
Right. By searching through millions of data points, yet providing this information to you succinctly and in a very easy-to-read format. So getting back to this paradox, these aren't just everyday errors, right?
No, not at all. These firms have virtually unlimited budgets. So what we're looking at are profound systemic breakdowns in the quality and interpretation of competitive intelligence.
Okay, let's unpack this. I want to start with a massive example of what goes wrong when everyone in the room just agrees with each other.
The TXU buyout.
Yes, the $45 billion leveraged buyout of Energy Future Holdings, formerly TXU. This was back in 2007, led by KKR, TPG, Goldman Sachs. For the listener who maybe doesn't live and breathe finance, what exactly is a leveraged buyout?
Right, a leveraged buyout, or LBO, is basically when an investment firm buys a company using a massive amount of borrowed money debt to fund the acquisition.
So they use the acquired company's assets as collateral.
Exactly. The goal is to make the company more profitable, pay down that debt using the company's own cash flow, and then eventually sell it for a huge profit. But because you're carrying so much debt, your margin for error is razor thin.
If revenues drop, the debt crushes you.
Completely wipes you out.
And that thin margin is exactly what brings us to the intelligence failure here. The investment thesis was deceptively simple, but it was built entirely on an echo chamber.
What we call the advisory echo chamber. Elite advisors, firms like Lazard and Credit Suisse, they operated on this unquestioned consensus that natural gas prices would just rise indefinitely.
Because TXU owned a huge fleet of coal and nuclear plants.
Right, which have very low fixed operating costs. So if natural gas prices keep going up, the overall market price for electricity goes up.
And that spread between their cheap production cost and the high selling price equals billions in cash flow. They were so confident, Lazard even solicited interest from over 70 potential purchasers.
And they all agreed. It just reinforced the echo chamber. But they had a colossal blind spot.
Fracking.
Exactly. The intelligence completely failed to account for the shale revolution. The widespread adoption of hydraulic fracturing and horizontal drilling was just taking off.
But how do the smartest energy analysts in the world, backed by Goldman Sachs, miss the invention of fracking?
Because the consensus intelligence models were looking in the rearview mirror. They just extrapolated past trends. They didn't integrate the ground-level technological shifts happening in Texas and North Dakota.
So they missed the impending massive supply glut of natural gas. Prices plummeted from over $12 to below $4.
A 60% decline. And remember, they had $40 billion in debt and lacked downside hedging because they were so certain natural gas was going up.
It's staggering. And it led to one of the largest bankruptcies in history, wiping out billions in equity. So human consensus failed miserably there. You'd think the fix is to remove human bias and let a machine do the thinking, right?
That's the logical next step people took, yeah.
Here's where it gets really interesting. Let's talk about Zillow offers and algorithmic arrogance.
Zillow decided to pivot from just listing homes to actually buying and flipping them using their AI algorithm, the Zestimate.
And under stable conditions, it had a decent error rate, but it failed due to something called concept drift.
Right, concept drift. The AI was trained on correlation, not causal AI.
Walk us through the difference there, correlation versus causal AI.
A correlative model identifies historical patterns. It knows houses with fresh paint sell for more in the spring, but it doesn't understand why. It has no grasp of causal drivers like supply chains or a global pandemic.
So the post-pandemic housing market hit, and the algorithm completely failed to account for acute shortages of contractors or skyrocketing material costs like lumber.
Exactly. Zillow's leadership was pushing for hypergrowth, aiming for 15,000 home purchases a quarter. To hit that, they actually went in and removed human guardrails.
They widened the confidence intervals and instructed the AI to bid more aggressively.
They took their hands off the steering wheel and slammed the accelerator. The software gave them an exact dollar amount, giving this illusion of precision.
But precision doesn't equal accuracy.
No, they ended up having to sell 7,000 homes at a loss, took a write-down of over $500 million, and had to fire 25% of their staff.
Just a catastrophic scale of a single intelligence error. And it happens in quantitative hedge funds, too. Look at AXA Rosenberg.
A prime example. They managed over $70 billion using a complex black box of algorithms to find underpriced stocks globally.
But there was a single coding glitch, a scaling error from a routine system upgrade that ignored 54 common risk factors.
Think of a scaling error like a misplaced decimal point in a massive funnel. For nearly 3 years, their competitive intelligence was fundamentally broken.
Identifying brilliant arbitrage opportunities that were actually just naked, unmonitored risks.
Right, and a senior executive discovered the error and actually concealed it from the board and clients.
That concealment cost clients $217 million. The SEC stepped in with massive penalties. It's terrifying when an algorithm is making millions of micro-decisions a day and humans can't manually check its homework.
You need a reliable way to filter and understand data without blindly trusting a black box.
Which is why IMN is so vital. Instead of drowning in data without intelligence like Zillow or AXA Rosenberg, IMN searches through millions of data points and provides the information to you succinctly and in an easy-to-read format. It really helps you avoid those algorithmic blind spots.
It makes a massive difference in how you process information.
And speaking of algorithmic flaws, you should check out the IMN podcast on the high rates of AI hallucination, available on our YouTube or other channels. It really highlights the dangers of taking automated outputs at face value.
That's a great recommendation, because when people get overwhelmed by data, they look for shortcuts. What's fascinating here is the concept of proxy due diligence.
Oh, proxy due diligence. This is basically looking at who else is investing, assuming they did the hard work, and copying their homework.
Like buying a used car without checking the engine just because the guy selling it is wearing a nice suit.
Exactly. And we saw this play out disastrously with FTX. Elite VC firms like Sequoia, Thoma Bravo, Paradigm, they poured billions into it.
Sequoia even published an article calling Sam Bankman-Fried a Goldilocks perfect founder. That kind of public endorsement serves as a massive trust enhancer for other institutions.
They relied on each other's reputations. And they relied on clean audits from firms like Prager Metis, which literally marketed itself as the first CPA firm with a headquarters in the metaverse.
It sounds absurd now.
How does a massive fund see an auditor in virtual reality and think, yes, this is the gold standard of financial scrutiny?
It was the frenzy of the market. They relied on these proxies and missed glaring red flags. FTX didn't even have a functioning board of directors.
They had no board. How do firms pour billions in without demanding a board seat?
In a normal market, they wouldn't. But investors were terrified of missing the next crypto unicorn. FTX used FOMO. They basically said, if you ask too many questions, we'll take someone else's money.
So they skipped the deep dive. Missed that there was no CFO, no compliance department, and customer funds were commingled.
And we saw the exact same pattern with the Celsius network. But this time it involved CDPQ, Canada's second largest pension fund. They fell into a yield trap.
A yield trap, offering returns way higher than the market average to mask extreme underlying risks.
Right. CDPQ relied on the pedigree of a co-investor, WestCap. They sank $150 million of pensioners' money into Celsius, thinking it was a safe yield.
But Celsius was throwing user funds into highly volatile DeFi protocols, a Ponzi-like structure where new deposits paid off old yields.
And the proxy due diligence failed to uncover that Celsius executives had historical ties to money laundering investigations.
Which was publicly accessible. A quick web search would have found it.
But they leaned entirely on the false security of a reputable lead investor. CDPQ eventually wrote off the entire $150 million.
So what does this all mean? From TXU to Zillow, AXA, FTX, Celsius.
It means outsourcing your skepticism is the most expensive mistake you can make. Whether you delegate critical thinking to an AI, a prestigious consulting firm, or a famous co-investor, the result is the same.
Flawed intelligence.
Right. You cannot replace genuine, independent due diligence with the pedigree of an advisor or the sophistication of a software tool.
And as promised, here are those final startling facts for you for staying with us. That Zillow algorithmic mistake. It wiped out $10 billion of their market cap in a matter of days. 10 billion, gone. And those elite VCs who relied on proxy due diligence for FTX. Firms like Sequoia and Paradigm are now facing class action lawsuits simply for touting FTX's credibility without doing the actual work.
It shows that if the most sophisticated financial minds on Wall Street can be blinded by a polished pitch or an overconfident algorithm,
how vulnerable are our own daily decisions to the illusion of automated certainty? Are we trusting algorithms and group consensus more than our own critical thinking? It's something to seriously consider. Thank you for listening to the IMN Podcast. This podcast is brought to you by IMN. Please be sure to visit the IMN website via the link in the channel profile to see how it can help you cut through the noise with personalized, succinct information. As a reminder, we try to make complex subjects easy to understand, relatively short in podcast length, and also provide insights that are often missed. Please subscribe, follow, and share across YouTube, Instagram, Facebook, TikTok, and X, and we invite you to come back for the next IMN Podcast.